Good afternoon, everyone. It gives me great pleasure to welcome you all to another insightful session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We deeply appreciate your continued participation, and today we focus on the critical yet complex area of financial reporting, lens on RPTs, that is, related party transactions, identifying accounting issues and why they matter. This 18th webinar in our series continues our commitment to enhancing professional knowledge and fostering a deeper understanding of key accounting topics. In today's session, we will explore the accounting complexities surrounding related party transactions under applicable accounting standards. The discussion will focus on how preparers and accountants identify, record, and disclose RPTs to ensure that financial statements present a true and fair view. We will address common accounting challenges, interpretational issues, and practical considerations that often arise in applying these standards. Our discussion will cover key areas such as identifying related party transactions and relationships, recognizing and measuring RPTs, evaluating the impact on financial statements, ensuring compliance with disclosure requirements. To make this session even more engaging and interactive, we have incorporated live poll questions. We encourage you all to actively participate by responding to the poll questions posted by our distinguished speaker by clicking on the open poll button below. Your input will help guide the discussion and enhance the overall learning experience. We look forward to an engaging and enriching conversation. Thank you once again for joining us. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, CA Maitri Swaminathan. Before we move forward, it's my pleasure to introduce the moderator for today's webinar, CA Nitish Agarwal. Nitish Agarwal is a practicing chartered accountant with over 10 years of experience in assurance, accounting, and advisory. He has served clients across sectors, with most of the time being devoted to financial services. Formerly associated with member firm of one of the big four auditing firm, he has also worked on assurance and advising engagements internationally, including during his time spent in the United Kingdom, UK. He brings together his passion for data, process optimization, and regulatory compliance to deliver well rounded practical solutions to clients. Over to you, sir.
Thank you, Rahul, for the amazing introduction, and we welcome Maitre ji. It's a pleasure for us to have you here. So, Maitre ji, I'd like to introduce you before the audience. So, Maitre ji is the founder of an advisory firm in the space of environment, social, and governance consulting. She is also the program director for sustainability with a leading consulting firm and an independent director and chair of the audit committee at a renewable energy company. With 3 decades of experience, Maitre ji was a rank holder as a chartered accountant and a company secretary. She's also a social auditor and has studied oil and gas accounting from the University of Texas at Dallas in the United States of America. Maitre ji is a faculty at the ASB Accounting Standard Board, a technical reviewer at the Research Committee, and a member of the Financial Report Review Group of the ICI. She was a member of the Women's Empowerment Committee of the NIRC of ICSI in 2024. In the past, she has been the finance director and CFO for India operations and controlled regional finance functions in a couple of leading Fortune 500 companies. Her experience spans across the energy, construction, and fintech industries, and she possesses strong leadership experience on domestic and international assignments. We welcome you, Ms. Maitri. Over to you.
Thank you, Nitish, and thank you, Rahul. And thanks to the audience for joining on this important topic. Today, as you all are aware, we're going to talk the lenses on related party transactions. And the topic of the day is why these matter more than ever. And, the first thing that comes to my mind when we talk of related party transactions is the recent Byju's episode, where, we've all seen what happened in Byju's, basically under investigation for a series of fraudulent related party transactions where they diverted millions of dollars to related parties and affiliated entities. And so more than ever, whether it's a startup, whether it's a large Indian conglomerate, all these related party transactions are very, very common. They're commonplace, they're there, and we need to understand what the disclosure requirements for these are so that we are not caught by surprise by the regulators asking questions about related party transactions. So we'll dive right into the technical aspects of this. Let me start sharing a presentation. Give me a moment. And Nitish, if you could confirm if my screen is visible.
It's visible.
All right. So we have 2 hours together, all of us. So please ask questions. This is a very, very interesting topic where everyone will have a lot of, practical experience and questions to ask. So let's use this time to make it interactive rather than, to use the slides just for education purposes. The point of having the slides is to spark the topic for discussion. And I'm expecting the audience to come up with a lot of questions, which can make the session interactive. And Nitish, whenever there's a question, please feel free to pause and we can jump straight into the aspects being, asked.
Sure.
So with that background, and we'll get started a little bit on the presentation as a base for all the questions that our audience, I'm sure, is going to ask. So the important part with related party transactions is how do we identify them? So identification of a related party transaction is possible when we understand what is the definition of a related party transactions. And a related party has been defined very differently in various different literatures, which apply to our companies as statutory guidances. So there is difference between how the Companies Act, how the Income Tax Act, and how Ind AS deals with it. Today, we are going to talk about Ind AS aspects and Ind AS 24 in specific, but we'll also be talking about AS 18, which is related party transactions, but less so for AS 18 than Ind AS 24. We'll be talking about the definition of related party there, understanding what does a related party transaction for the purpose of disclosure under Ind AS mean, and how does that compare to various other definitions of a related party, because that's the primary building block on which our disclosures will sort of rest. And unless we understand who is a related party, our entire exercise of doing the disclosures will fail. So we'll understand what do we mean by a related party, and then we'll say what are these transactions. So we're talking of related party transactions. So what is a transaction? What are some judgments in the disclosure that we'll have to make? Because obviously a disclosure will require some judgments. What do we need to disclose, and in what circumstances are these disclosures required? Any strategic or governance implications of these, we can talk about all of that. And then we'll talk about a few case studies. So that's broadly how we are structuring today's discussion and what I'll be going through in my presentation. Like I said, feel free to raise questions. So what are the laws, in the country relating to related party transactions? We'll begin there and then we'll narrow down to the scope of our discussion today. So the laws that relate broadly to related party transactions are the Companies Act 2013, all the rules made under the Companies Act. And under the Companies Act, we also have the secretarial standards, which tell us when do we need special resolutions, when does it need to go to the audit committee, and so on and so forth. There's also a guidance note by the Institute of Company Secretaries, updated in 2023 on related party transactions. So all of this literature is available as far as related party transactions is concerned under the Companies Act. And what these do is, Section 188 of the Companies Act, like we know, has the definition of what is a related party and so on. But what these broadly achieve for organizations is procedural aspects and procedural requirements of what needs to be done as far as related party transactions are concerned. When I say procedural, when do we need to go through a shareholder's approval? When does every transaction, of course, needs to go through the audit committee? And what kind of approval is required from the board and from the shareholders. All of that is given under the Companies Act. Then we move on to, in case of listed companies, we have the SEBI listing disclosures. So for the listing disclosures, what we have under that is regulatory requirements. So the SEBI gives the regulatory requirements, and clause 49 of the listing agreement has it. And under that, it gives what are the regulatory requirements, what are the disclosures, what do we mean by related party as far as the SEBI LODR is concerned. And then apart from the procedural aspects contained in the Companies Act and the regulatory aspects contained in SEBI, we've got the disclosure requirements, which are laid down under the accounting standards. So in terms of IGAP, we have AS 18. In terms of Ind AS, we have Ind AS 24. And these primarily deal with disclosure requirements for what needs to be disclosed as part of the financial statements of an organization. In addition to this, what is not mentioned on the slide is also the Income Tax Act, which deals with transfer pricing. So wherever there's a related party transaction, there might be transfer pricing implications of this, whether the transaction is domestic or whether it's international. Both of them could have transfer pricing implications, and how to deal with these transfer pricing implications of related party transactions. That entire literature is contained in the Income Tax Act. So why is it so important, and why are related party transactions given so much statutory importance that we have so much of procedural, regulatory, tax, and accounting guidance around this subject? So let's talk a little bit about that. So related party transactions, of course, are a normal part of business, right? There would be entities which will have associates, which may have joint ventures, subsidiaries, parent companies, and so on and so forth. And each of these may be engaged in businesses that are synergistic. And as far as there are synergies between business, there's nothing to prohibit a transaction with somebody who might be called a related party, as per the definition, whichever applies to it. While there is no prohibition on transactions with a related party, but there are, wherever there is a related party transaction, stakeholders may be interested in learning about the existence of the relationship and what is the nature of transactions. And they're interested in this because if there is a transaction, the transaction may or may not be at arm's length. So if there is a parent company which is sourcing all of its material from its subsidiary, the purchases of the parent company may or may not be at a arm's length price, which means the input cost in the parent's financials may or may not reflect market reality. As far as such a subsidiary is concerned, since its entire market is comprised of the parent, and it may not really be aware of the competitive realities of the market, and therefore it may suffer from some issues in terms of modernization of technology. Maybe the competition is investing in better technology because they have to build their market, they have to market their product. But the subsidiary has a ready-made market in the parent and may not necessarily be investing in technology to upgrade its manufacturing process. And in doing so, perhaps long-term competitiveness may be impacted. So these are some of the reasons. Even if there is not a price differential between the parent and the subsidiary, it is possible credit terms are different. It is possible also market competitiveness is impaired. It is possible also there are restrictions on operation of an associate or a joint venture. And these restrictions on operation may actually impact the long-term financial viability of an organization. So for instance, if I'm in the business of manufacturing automobiles and I acquire a subsidiary which is in the business of manufacturing steel. So far for my automobiles, I may be acquiring my steel from one of the large steel manufacturers of India, say SAIL or Tata Steel or somebody. And now that I have a subsidiary which manufactures steel, I may source all of my steel from my subsidiary. Now, what does that do for me as a car manufacturer? So the risk that is there for me as a car manufacturer is that my ability to buy steel at a better price, or maybe at a better terms and conditions, is lost to me as a car manufacturer, whereas my competitors who may be manufacturing competing brands of car have not lost that competitive advantage. And for my stakeholders, it is very important that they understand that this ability, this risk exists where I'm sourcing everything from a related party, which is why whether or not the pricing of a related party is at arm's length or not, it is important that the related party transaction is disclosed. So we just talked of the Byju's example, and today's session is why these transactions are important. So on that line, if we look at the example as an accountant, if we look at the example of Paytm, what happened and what drove the problems in Paytm, if we dive into them. So in the case of Paytm, SEBI had issued an administrative warning over related party transactions to Paytm. And basically, there was related party transactions between Paytm's payment bank and the parent company. And this was just the tip of the iceberg, after which we know how Paytm's payment bank is no longer active. And there have been regulatory implications for Paytm as an entity where the payments bank piece of the business is no longer active. What is the implication in terms of numbers for Paytm? If we look at that, the implication is in the range of 300 to 500 crores for Paytm by not having the Paytm's payment bank active. So as accountants, as business owners, as stakeholders, related party transactions are very, very, very important. Let's also look at it from, is this important also from the auditor's lens? So from an auditor's lens, one of the examples that I found was Mafatlal, which was issued. There was a criminal complaint against Mafatlal, which was filed by against the partner. Actually, it was a Big Four partner who had audited the accounts of Mafatlal, and there was a criminal complaint filed for alleged non-disclosure of related party transactions in the audit report. Of course, this complaint was dismissed by the Gujarat High Court, but it just highlights the importance of attention to related party transactions by auditors as well, because not doing so and receiving such notices from statutory authorities such as the ROC places us under a lot of mental, financial, and a lot of reputational damage as well, which is very avoidable if we can make sure these related party transactions are well disclosed in our financial statements. So we've looked at it from the point of view of accountants, we've looked at it from the point of view of auditors. What about investors? So what about investors? Let's look at it from the perspective of investors. And there was a recent IPO, the IPO for LG Electronics, which I was looking at. And if you look at the IPO disclosures for LG Electronics, here's what it says. It says royalty payments to the promoter, which is LG Electronics Inc. This promoter holds 85% stake in LG Electronics India, and the promoter can increase the royalty up to 5% of turnover without shareholder approval. So in this sense, it's a huge risk for minority shareholders because it impacts their rights, obviously. So if I'm a minority stakeholder who's planning to invest in the retail category in an IPO, and in looking through the IPO disclosures, if I see related party transactions which are likely to impact my rights as a minority, obviously it's a red flag. The other red flag here is also that there are about 5,000 crores in contingent liabilities, including disputed transfer pricing claims. So which means the pricing between the parent entity and the subsidiary in India is being questioned by the tax authorities. And therefore, what if the litigation outcome is unfavorable to LG Electronics India? So that again, being a related party transactions, it highlights for an investor what risks there can be within such related party transactions. So, we've kind of discussed why related party transactions are important from the point of view of accountants, from the point of view of auditors, as well as, as an investor. So every category of stakeholders, it is very, very important for us to understand what are related party transactions and ensure that the disclosures are made. And if we are stakeholders in an organization, also to read and understand these disclosures. Right. So what does India's 24 attempt to do? It attempts to provide guidelines around the disclosure of related party transactions. It's as simple as that. It's a guidelines on disclosure of related party transactions, being a critical aspect of corporate governance. Okay. I'm going to pause here for any questions. Nitish, if there are any questions at this point, happy to take them.
No questions yet in the chat box. But
Okay.
one request, Mitriji. So when
Yes.
you take up the SEBI requirements, or when you say take up the SEBI's view on listed entities, so these days a lot of these entities have also come up which are not listed in equity, and debt listing is a common proposition for a lot of these companies. So how does SEBI's lens work when it comes to related party for a debt listed company? If you could
Okay.
cover that thing as well.
We'll talk about that. We'll
Sure.
talk about that.
Thank
We are going to be focusing a lot, Nitish, only on the Ind AS aspects.
Sure.
But when I come to SEBI, briefly, we'll touch upon that.
Thank you so much. Thank you.
Okay. So so what is in scope? Every single organization, related party transactions. This accounting standard is not industry specific. So it applies to all organizations which have related party transactions. We will, of course, be talking about who is a related party under the accounting standard. But where does it not apply? So if there is a statute under which a disclosure is not warranted, then in India, entities are allowed not to disclose the information. What might be some examples? So it could be hospital confidential information of patients who are related parties. It could be bank information on related parties' transactions. And those, if they are not required to be disclosed as per the laws pertaining to hospitals, maybe privacy laws, or pertaining to banks, then they don't need to be disclosed under Ind AS. So this is an exception given under Ind AS for disclosure. So primarily where the disclosure is in conflict with any duties of confidentiality under any statute, rules, regulations, competent authority, etc. Then they don't need to be disclosed. So let's move on to what is a related party. What is a related party? A related party under Ind AS is defined as anybody who may be a person or an entity. It could be either an individual or another entity. There are two types of relationships. Now, who are the persons who are related? We'll look at the entities who are related. What are the circumstances in which an entity is deemed to be a related entity? We'll look at that as well. One thing that the standard clarifies, which we should bear in mind as we dive into, persons who are related and entities that are related, is the standard clarifies that in considering every related party, we have to go with the substance of the transaction and not the form of a transaction. So when we talk of substance of a transaction, the beneficial owner of shares, if it's an individual, we need to get into the beneficial ownership. So it's the substance of the transactions, the form may be different. So if there are any indirectly structured related party transactions, that's what would bear for getting into and understanding the depth of the indirectly structured related party transactions, as well as any transactions that are done through intermediaries. Again, we need to understand what is the substance of the transaction and not stop at the form of the transaction. Okay. So when is a person said to be a related party? A person is said to be a related party when they have control. Right? What do we mean by control? It is more than 50%. But again, we look at substance and not form. We'll look at some examples of that. When there is significant influence, which means more than 20% of voting power, less than 50%, and when the person is a key managerial personnel of the entity or of the parent. So not just of the entity, a key managerial personnel of the parent will also qualify as a related party. Okay. So let's look at who are key managerial persons and what is a close member of the family, and then let's dive into a lot of examples of this. So when we talk of close member of family, what does that mean? It talks of children, spouse, or domestic partner, brother, sister, father, mother. children of the person's spouse or domestic partner, and dependents. So it talks of all of these. Now, how does this compare with the definition of a related party under the Companies Act? So under the Companies Act, the definition of a related party is pretty similar, but the Companies Act also includes in its definition son's wife, daughter's husband. These are two categories that are included in the definition in Companies Act, but don't form a part of close member of family as far as Ind AS 24 is concerned. On the other hand, in Ind AS 24, we are talking of domestic partners in all categories, right? Spouse or domestic partner. The word domestic partner has not yet found a place inside the Companies Act. Companies Act only talks of wife and husband, spouse, but does not talk of domestic partner. Similarly, Ind AS also talks of dependents or that person of that person or the person's spouse. Companies Act doesn't talk of dependents. So there are some nuances between how a related party is defined under the Companies Act, how it's defined under Ind AS. Let's also compare with the international IFRS. So IAS 24, which deals with related party transactions, the IFRS pronouncement IAS 24, which deals with it, talks only of spouse, partner, dependent child, and relative sharing the household. So if there's a relative who shares the household, then they are a close member of the family. So the Indian definition is much wider because in India we have close-knit families where brothers, sisters, children remain connected even when they grow up. But in the IFRS context, it is only dependent child. So once the child is independent and earning on their own, they are not part of close member of family. And similarly, brothers, sisters, etc., father, mother, all of them are not included unless they share the household. So these are some fine points of difference between the IFRS definition of related party and Companies Act in Ind AS. Why is the IFRS definition important? Because a lot of us work for organizations that are growing across the globe. And for reporting purposes outside India, just because we are following Ind AS, it doesn't mean we don't. It doesn't mean just adopting the entire disclosures as per Ind AS for the IFRS reporting purposes. For IFRS reporting purposes, in the definition of close members of families, there's a fine difference. So those of us who are working for organizations that have presence across the globe, this is an important point to note that the disclosures made for Indian purposes may have to be slightly different from the disclosures made for IFRS purposes overseas. Okay. So a person, close member of the person's family, or key managerial personnel. So who are key managerial personnel? Moving on to key managerial personnel, people who have authority and responsibility for planning directing, which means even the independent directors. The definition very clearly says whether they're executive or otherwise, which means even independent directors, non-executive directors, nominee directors, all of them are included in the definition of key managerial personnel as far as Ind AS is concerned. So, if there is a managing committee and the committee has authority over the organization, over the planning and the directing, reporting of an organization, then even the members of that managerial committee will be key management personnel. And the definition says that key managerial personnel are those persons who are related parties, right? And it talks of, so key managerial personnel don't necessarily have to have control, but in case of persons, individuals and close members of family who are not key managerial personnel, they must hold either controlling stake or significant influence on the organization. What do we mean by control? So control is a term that's not defined in Ind AS 24, but is defined in Ind AS 110 on consolidated financial statements. And the definition of control, I'm sure many of you are aware, is power over the investee, having exposure to variable returns, and using this power to influence that variable returns, which means I'm a shareholder, my returns are not fixed, they will vary according to the earnings of the company. But how does the company earn? Where does it invest its capital? Those are decisions which I, as a shareholder, have the ability to influence. And therefore, I have control over the organization, I have variable returns, and I use this control to influence those variable returns. In such a case, I am having a controlling stake in the organization. On the other hand, what do we mean by significant influence? So the Companies Act, under the definition of associate companies, has defined control to mean at least 20% of the voting power of an organization. Ind AS goes in the same format, and it says investment in associates, joint ventures is, in that it says that where an entity holds directly or indirectly 20% or more of the voting power of an investee, then it's presumed that the entity has significant influence. So the definition in the Companies Act and under Ind AS is pretty much identical for that. The only change here is that the SEBI listing regulations, with effect from 2023 April, has changed this threshold to be 10% as far as SEBI listing requirements and their regulatory procedures are concerned. The significant influence begins from 10% controlling stake and not from 20 as in the Companies Act and Ind AS. So since we've understood who are the people who have a controlling stake, let's just take a few examples, because practically these are the issues which give rise to some confusion as far as whether to give disclosures or not are concerned. So if there is a person who is holding 51% of equity share capital of a company, in that case, they have control and therefore would fall within the definition of a related party. But let's look at a case where a person has only 48% stake. Okay. The person holds 48% stake in the company. The other 52% is held by thousands of shareholders holding small number of shares. There's no significant shareholder who holds any significant share, but this one individual holds 48% stake. Now, these thousands of shareholders don't have any agreement to act together, to collaborate, no shareholders agreement between them. Therefore, in such a case, we are looking at substance over form. And in such a case, whichever direction Mr. AB decides, the person who's holding this 48% stake, decides to exercise his voting right, basically that will determine the eventual decision made by the company. Since that is the case, de facto, this person is holding control of the organization, and going by the theory of substance over form, even with 48% stake, it can be said that the person is a related party having a controlling interest in the organization. So we don't have to define ourselves by the threshold of 50%. Even less than that, if it amounts to de facto control, then the clauses relating to control will apply. On the other hand, let's look at another example. So in a company, one person holds 40% shares. The remaining 60% are held by six different people. They all hold 10% share each. So 6 different people holding 10% share and one person holding 40%. And they agree that this person holding 40% shares will have the authority to approve and remove all managerial personnel, will have the authority also to set their remuneration. So one person who is holding 40% share has been empowered through a shareholders agreement to take decisions on appointment, removal, and remuneration of managerial personnel. By doing so, and this shareholders agreement effectively bestows control upon this person, even though he's holding only 40% shares. In such a case, this is seen as a circumstance where the person has control. So control, again, I will reiterate, control does not depend exactly on 51% stake. It could happen that the stake is less than 50%, but because of either de facto control or because there is a shareholders agreement that bestows control to an individual, in such case, an individual may have control over an organization. And therefore, the related party transactions that apply to control will have to be made in such a circumstance. We can go on with examples on this, but I will take just one more example on this. So there is a person, individual, and Nitish, if there are any questions, happy to take them.
Sure. So I have one, but maybe you can finish the example and then I can.
Sure. So that if an individual has, say, 45% stake and has the power to appoint 3 directors in an organization, the rest of the shareholders who hold 55% stake have the authority to appoint the remaining 3 shareholders. There are total 6 shareholders. The individual holding 45% appoints 3. The various individuals holding 55% appoint the other 3 directors. In such a case, if there's a clause in the articles, so we don't have to just go by this shareholders agreement, we need to look into the articles as well. And if there's a clause in the articles which says that the chairman of the board will have a casting vote, and if the right to appoint the chairman of the board vests with the person holding 45% stake, then effectively, since the casting vote lies over there, the person having 45% stake would have control over the organization. So that is the other circumstance in which you could potentially have less than 50% shares, but yet have controlling stake and therefore have to apply the disclosures for control. Nitish, over to you.
Sure. So the question that I had, Mitraji, was from a practical standpoint, most of the times, while we understand, there are so many definitions and the definitions have the words like planning, directing, controlling, and authority, responsibility. But most of the times that when we say audit or interact with organizations, the actual disclosures, even where the auditors are, say, larger firms, we see are restricted to those that are based on thresholds. Have you come across instances or examples where you would have seen, say, people with lower thresholds, say at a threshold of 5% or holding just 5% or say less than 50%, but still in many of these cases exercising significant control or exercising authority responsibility, but which is not, say, clearly demonstrable on paper, but when you get into the organization, you can clearly sense it. So would you be able to relate to such an example or share such an example?
So Nitish, while I don't have a ready example of where it's happened, there is a lot of responsibility, like I said, on auditors. The amount of responsibility is not reducing, we're all aware. And the amount of regulation on auditors, the amount of scrutiny that's coming from various places, not just the NAFRA, but the Registrar of Companies and various other authorities, SEBI, etc., which are reaching out directly to audit committee leads, which are reaching out directly to auditors, places the responsibility squarely on those charged with governance, of course, and then the auditors on diving below just what is visible on paper. What is visible on paper is very clear. It is what we were traditionally trained on. Take the documentation, and go as per the documentation. This requires a little bit more of a deep dive. And this is where we'll have to sort of little bit change our approach. So what happens if, there is a share buyback where I'm holding a stake, and the stake might have been, 30% before the buyback, but I did not offer my shares for buyback, and therefore after the buyback, my stake has changed, right? There are many cases where without even an active change in the shareholding, there could actually be a change from significant influence to control, or from control to significant influence. It could move either way. Are we doing that little bit of extra due diligence to get into the facts of the case? And I would say this responsibility falls more on those charged with governance, and being part of audit committees and things like that. I can tell you very clearly that we don't just go as per what comes on the table. We understand, we sit with management, we understand what are the changes, we get into the financials of subsidiaries and of associates and things like that, and understand a little bit more on what is happening there. And when you do that, there is a lot that comes out which may not be there on paper. Like things, some of the examples that I took, one of the examples was where there's a shareholders agreement. A shareholders agreement between other shareholders. So what I hold is 45%, but the shareholder agreement may be with between the shareholders holding 55% shares. May not necessarily be in the public domain, right? But the pattern of voting, and by talking to the company secretary, we clearly understand these things. What is the pattern of voting that's happening? How do the votes swing? Who is the person whose votes carry out resolutions? It's important to understand this, and a lot comes out through these discussions which may not necessarily be documented and available for us in terms of a paper trail. So that's where the responsibility is shifting from merely looking at paper trails to going beyond that. I don't have a ready example. I know you wanted an example of where I've seen that happen. I don't have a ready example. But
No, I think this is also helpful.
But India's 24 is simple. We're only talking of disclosures. And unless there is a disclosure that doesn't require to be made as per statute, where is the harm in going above and beyond and giving disclosures that are more transparent?
Right.
And that is the culture of corporate governance. That is the culture of transparency that we want to drive within corporate India, and that a lot of corporates are adopting today. So I think it's a very, very relevant question that you asked, and triggers the importance of wanting to go over and above. Did that clarify?
Yeah. It does. Sure.
Okay.
Thank you.
All right. So, individuals. So these are the individuals who are either shareholders or close members of family, or key managerial personnel, which is directors and other key managerial personnel of the organization. Let's move on to companies which are related parties. And this is going to take a little while to go through this list of the relationships that are defined within the accounting standard. The relationships that are defined within the accounting standard are when an entity and the reporting entity. So the reporting entity is the one for which we are giving the disclosures. The reporting entity and another entity where they are members of the same group. Okay. Then they all they are related. So any member of the same group to which a reporting entity belongs is a related party. If there are two companies which are subsidiaries of a parent company, subsidiary 1 and subsidiary 2, and the parent also has other subsidiaries, all these subsidiaries will be related to each other because they are under common control. So all the subsidiaries are related one to the other. Similarly, if there are joint ventures, so where an entity is a joint venture of another entity, and then is part also of a group where one more entity is the member. So there is a group of entities. There is an entity which is a member of that group. There is another entity which is a joint venture of a member of the group. So both the joint venture and any entity that's a member of this group will all be related to each other. So, we've got examples here where S1 is a member of a group P. There's a group parent company P with a group of companies under them. S1 is a member of that group. And S1 makes a joint venture with R1. And there's another company E1 which is also a member of the group. So the joint venture of S1 and E1 are related to each other, right? Similarly, where two entities are joint ventures of the same third party. So, for example, if we go into the balance sheet of, say, Tata, there are a number of joint ventures which Tata has entered into. So, Tata has entered into a joint venture, with the telecom company. Tata has entered into a joint venture with an insurance company. Both of these joint ventures, in which Tata is the common investor, both of these joint ventures are related to each other. Of course, in the insurance sector, if Tata has entered into a joint venture with AIG, okay, and in the telecom sector, if Tata has entered into a joint venture with AT&T, it does not make AT&T a related party of AIG. Only the two joint venture firms which are formed, which is Tata AIG and Tata Telecom, are related to each other. The co-venturers, which are the venture partners such as AIG or AT&T, they don't become related parties on account of this relationship. We see a lot of disclosures on balance sheets on account of joint ventures, which are related parties. And, there's a long laundry list of joint ventures which are related parties to every entity. And it's on account of, this feature of the accounting standard, which defines these joint ventures as related to each other. Okay. So a joint venture of an entity and an associate. So the joint venture and the associate will both be related to each other. Similarly, if there's a gratuity fund or a post-employment benefit fund, which the entire group is investing into, then that is related to all the entities in the entire group, right? So whoever's contributing to the fund becomes related. Then if there is a member of a group which provides key managerial personnel services to one entity or to its parent, then the entity that's providing the KMP services becomes related. Similarly, if there is a key managerial personnel of an entity and there is a parent company or a subsidiary of the entity, then that KMP becomes related party of the parent or subsidiary as well. And all associates, joint ventures become related to each other. We'll look at this through an example. We'll look at this through an example to understand this. Where there is no related party is a director of two different publicly listed companies. These two companies do not become related to each other. So just because there is a common director or common KMP between two organizations, the two organizations don't become related to each other. Okay, so common directorships, unless the two organizations have a parent-subsidiary relationship, common directorships don't cause the two entities to become related to each other. Similarly, we just saw co-venturers, the case of AIG and AT&T not being related. So if they're co-venturers in a joint venture, the co-venturers don't become related to each other. Let's look at an illustration of the complex nature, because that's the real nature of Indian business, right? So there is a parent entity, there are controlling interests in subsidiary A and B. Subsidiary B has a further drop-down subsidiary, which is subsidiary C. C has an associate and the parent has two associates, right? And they are associates because there is significant influence. So let's look at this. So in the parent's separate financial statements, right? Subsidiary A, B, C, associates 1, 2, 3. All of these are related parties as far as this parent is concerned. So wherever there is a parent concern with a number of subsidiaries and associates under its structure, all associates and subsidiaries under that structure are considered related to the parent. And let's look at it from the point of view, from the lens of subsidiary A. For subsidiary A's financial statement, the parent, these two subsidiaries, because they are co-subsidiaries, those sister concerns, so subsidiary B and C, the parent company, and associates of the parent company or associates of the sister companies, they are all They are all related parties. Similarly, for B, all of these are related. The parent, subsidiaries AC, and associates 1 to 3, all of them are related. Similarly, let's look at subsidiary C. For subsidiary C, the parent, these two subsidiaries and associates, all of them are related. So for each of these, the parent and the subsidiaries, all these under the structure are related to each other. When we look at the associates, for the associates are not related to each other. So the associate 1 is related to parent and these 3 subsidiaries, but not related to these 2 associates. Similarly, associate 2 is related to the parent and subsidiaries, but not to the associate 1, right? And if we look at the consolidated financial statement of this group, then these will get consolidated. Subsidiary A, B, and C will get consolidated, and associate 1, 2, and 3 will be related parties. So in the separate financial statements, all of them will be related parties. In the consolidated financial statement, these will get consolidated and these will show as related parties. So when we are talking of separate financial statements and consolidated financial statements, again, one important aspect to keep in mind is that the related party relationships in the separate financial statements don't just get reported in the consolidated. We will need to do a slice and dice of the relationships and ensure that those that are consolidated already don't also reflect. So with that, we've pretty much covered the definition of a related party. Nitish, I'll pause here if there are any practical questions which our viewers may want to raise.
Sure. So we've got a couple of questions, but I'm just trying to filter which one can be relevant at this point of time. So one question is, if a related party transaction is cancelled or reversed during the year, does it still require disclosure?
The related party transaction is required to be disclosed for that financial year where the relationship existed.
Right. So the question is around whether a transaction which was reversed or cancelled. So probably something like sales done but sales returned, and then say, for example, something like a guarantee given but guarantee subsequently cancelled. Something like that, probably the intent of the questionnaire is.
So what we're trying to say is that the transaction never happened, right?
It happened but was
that's the
undone
bottom line.
later. Right.
That the transaction never happened. We entered into a contract but did not fulfill the contract, right?
Correct.
That does not need to be reflected because the transaction never happened. The bottom line is the contract was entered into and it was rescinded perhaps. So that does not need to be.
Sure. Does Ind AS 24 also cover non-monetary transactions?
Yes, it covers. So we're just going to step into the definition of what is a transaction, but the presence of a price is not necessary. So for example, if there is a parent company guarantee, a parent company guarantee does not involve any exchange of consideration.
Right.
But there is commercial substance to the transaction. So wherever there is a commercial substance to the transaction, there's a beneficiary of the transaction, which is a subsidiary. The subsidiary is getting some commercial benefit and is able to enter into some sort of a business on account of receiving this parent company guarantee. And therefore, there is commercial substance and therefore it needs to be disclosed. So the presence of a price is not necessary.
That's it from whatever topics we've covered so far. We've got a couple of more, but I think they should be covered as you speak further.
Sure, I'm looking for the poll option because I know that we had worked on some polls, but I'm not able to find the button which will trigger the poll. So we'll do this verbally instead of the electronic poll on the system. I've been asking the audience for questions. Now it's time for me to ask a couple of questions, I guess. It's always a two-way street, right?
Right.
So my first question is, I am the key managerial personnel of an organization. And in the disclosures I need to make, do my father-in-law and mother-in-law need to be disclosed as close relatives?
So I think, Maitriji, if you just read out the question, the audience will click on the button on their side to answer. So they can see the option of responding to the poll. You will not be able to see that. I think we should be able to see the responses once they come.
Oh God, okay. If that's the way it has to work, then
I think given
it's
that
going to
you've
be very
already read the
difficult for me.
question.
I'm technologically challenged.
No, I think you just need to read your question. Given that you've read your question,
Oh,
the
I was
audience has
expecting to
not
see it
seen.
on the board, so I haven't. I'll need to toggle screens, and I'm not. Let me do that then. Give me a
Sure,
moment to toggle screens.
sure.
I will request if poll question number one can be put on the screen.
Sure. I'll just try to get that file and baby project on the screen.
Yes, while we're just moving into, what is a transaction? This question is relevant to trigger off that discussion on what is a transaction. So a company is purchasing 70% of the total sales of another company. Does that amount to a related party transaction? And request the audience to participate. We are among friends here. There are no right or wrong answers. Do we have some responses, Nitish?
Rahul does say we've got responses, but I think those should show up later. But we've also got the second question on the question box. Your questions.
Second question on the poll is also put up. Okay, the question
Right.
is a company is the sole selling agent of another company. So is there a related party transaction? While the audience is attempting these two, well, we'll jump into, because these are questions on what is a transaction. So what is a transaction? A transaction is, when is there a related party transaction? When there is a transfer of resources, services, or obligations, right? And whether or not a price is charged. So it is irrelevant whether a price is charged. So just because, and there are some exceptions to what relationships are not included in related party definitions. So while, in case of a sole selling agent, there is a sale purchase transaction. In case of a purchase transaction of 70% of sales, there's a purchase transaction. But the question is, are they related parties? So there has to be a transaction and there has to be a related party. Now, in case a customer, supplier, franchisor, etc., with whom an entity transacts a significant volume of business, if that is the case, that doesn't necessarily cause a related party transaction, as long as the other entity is able to independently take its decision. For example, there are a lot of automobile ancillary suppliers, and I stay in Gurgaon, and a lot of the automobile ancillary suppliers supply to Maruti in Gurgaon. But just because all of their produce is purchased by a single company doesn't make them related to Maruti, because these companies are free to take independent decisions on how to run their business. So how they run their business, what manufacturing method they use, how they price their product, whether they start a new line of business or not, whether they enter into other joint ventures, is totally decided independently by the boards of these auto ancillary companies. And therefore, just because they're transacting a large volume of business or all of their business with a single purchaser doesn't make them a related party to that purchaser. Right. Similarly, there are banks, and a lot of times, the banks, when they provide loan, as part of the loan agreement, banks nominate somebody to occupy a non-executive observer seat on the board. So there are nominee directors very often where there's a loan from a bank. You would notice nominee directors on the board of the borrower. Such nominee directors basically have the role of an observer, and they have the right to veto on certain items, certain transactions only. So where there are transactions which impair their own rights. For example, if the loan is against hypothecation of stock and there's a decision in the company to reduce production and reduce stocks, things like that, this nominee director will have the right to vote about it, or if there is a decision to sell large part of the company or to hypothecate a large part of the assets, then the bank nominee director may have a right to object to that. In such cases, since the nominee director is only an observer seat, the nominee does not become a related party of the organization. The other thing, when we talk of a related party transaction, so the concept of transaction happening in the ordinary course of business, in the Companies Act, there's the concept of transaction happening in the ordinary course of business, and where a transaction is in the ordinary course of business, there is a set of resolutions that's required. Where it is out of the ordinary course of business, the nature of the resolutions will change. We'll not get into the details of that, but the concept of an ordinary course of business does not exist. Any transaction with a related party will need to be disclosed as per the disclosure norm, which we will be discussing as we move forward, right? So all these relationships, which is bankers, if there's a relationship with a trade union or a public utility, electricity or water company, all of this does not qualify as a related party. Okay. Many times, the government, it does not control the reporting entity, but may require, may be part of the, sitting on the board for certain decisions. So this could happen in case of polluting industries, where members of the government are invited to attend, meetings where expansion of the plant is there, and they can get more transparency into what does the plant expansion involve and what kind of environmental clearances are required. At times, government pollution authorities are invited into such meetings, but just because they're invited into board meetings does not mean that they control or jointly control the entity. So in such cases, it is not a related party. So what is a related party transaction? We just said that it's a transfer of resources, services, etc., whether or not a price is charged. So again, differentiating between Income Tax Act, arm's length price, transaction price, all that is irrelevant. There is no relevance of transaction price being at arm's length or not. We are not asking whether there doesn't need to be a price at all. Just because there is a transaction, that is sufficient to trigger a disclosure. So that's the difference between India's 24 and transfer pricing regulation, where concept of arm's length exists over there, but in India's, just the fact that there is a transaction, whether or not a price is charged, is sufficient to trigger the necessity for a disclosure, right? So we already talked of parent company guarantees. So has commercial substance, but there is not necessarily any price exchanged for it, but will fall within the definition of a related party transaction. What are the disclosures? We'll come to the conclusion of this and then we'll take up questions. So what are the disclosures that are required to be made? There are two categories of disclosure. Category one of disclosure is where there is control. So wherever there is control, then relationship needs to be disclosed even if there is no transaction. So where there is control, where there is a subsidiary, where there is more than 50% stakeholding, then control is there. And where there is control, we have to disclose the relationship, not necessarily whether there is a transaction or not. So in all financial statements, we've seen holding and subsidiary company details are given in all cases, even if there is no transaction. And this is primarily because the relationship needs to be disclosed. Second category of disclosures is where the transaction needs to be disclosed. If there is no transaction, no disclosure is required. However, if there's a transaction, the transaction needs to be disclosed. So wherever there is more than 20% stakeholding or where there's significant influence, the category of significant influence requires transaction-based disclosures. And similarly, for KMPs, transaction-based disclosures is required. What is the payment made to KMPs primarily? And these payments have to be categorized in the same categories as employee benefits, which is short-term benefits, long-term benefits, termination benefits, post-employment benefits, and share-based payments. So in these 5 categories, any payments made to the KMPs needs to be disclosed. Okay. So category 1, where just the relationship has to be disclosed, whether or not there is a transaction. Category 2, only if there is a transaction, then the relationship as well as details of transaction need to be disclosed. What needs to be disclosed in case of a control-based disclosure? The name. What is the name of the parent or subsidiary? That needs to be disclosed. Okay. And then after this, there are the details of what needs to be disclosed. So what is the amount of the transaction? What is the outstanding balance at the end of the year? What's the terms and conditions? Whether it's secured, unsecured, etc., any guarantees. And, all of these details need to be disclosed. Anything that's missed out is a cause for notices and issues. And so these are the disclosures that organizations ordinarily have to make. We have some exemptions from disclosures. So exemptions from disclosures are made where it's a government that has control or joint control or significant influence over a reporting entity. Okay. And the relationship is primarily because the same government controls both entities. In such case, there is an exemption from disclosure only for government companies. So anything other than a government company, there are no exemptions. Even if the related party transaction is at arm's length, it needs to be disclosed. But in case of government companies where the government has control or joint control, there are exemptions. What are these exemptions? The exemption, if this exemption is availed, then the company needs to disclose what is the name of the government. Is it central government, state government? What is the name of the government? What is the nature of the government's relationship? It is control, it's joint control, it's an associate, it's a significant influence. What is the nature of the relationship with the government? What is the nature of individually significant or transactions that are significant in aggregate? Those have to be disclosed. And I have examples coming up on what those disclosures look like. So in case the government, so for example, this government is controlling both entity 1 and 2. Entity 2 has 2, drill down subsidiaries. Entity 1 has 2 drill down subsidiaries. And there is a person X as well, who's a KMP in entity 1. So the exemption applies to transactions with the government, okay? So if this entity has any transactions with the government, this entity has any transactions with entity 1, 2. So let's say this is the reporting entity, entity A. Entity A's transactions with the government, entity A's transactions with any of these other entities does not need to be disclosed. It falls under the disclosure exemption. And we merely have to show that there is a government which is controlling all these entities, and therefore transactions between these entities are not disclosed. But any transaction with KMP of entity 1 will need to be disclosed. There is no exemption to transactions with individuals who are KMPs. So transactions with this individual don't fall under the exemption. Similarly, what are some, individually significant transactions that need to be disclosed? So this is the kind of disclosure that needs to be made. If an individually significant transaction is there, even if both entities are owned by the government. So then, the disclosure would be like the entity, which is a utility company in which the government indirectly owns 75% of the outstanding share, sold a piece of land to another government-related utility company for this price. A plot of land in a similar location, similar size, similar characters, similar time period was sold for 3 million. There had not been any appreciation, depreciation of the land, and see note for disclosure of government assistance and note for accounting for government grant. So this is how the disclosure of a individually significant transaction would happen. If there is a significant transaction between government entities, it still needs to be disclosed. Similarly, if there is a transaction that is significant because of its size, right, then you might like to give a disclosure of this kind, which says that the government provided the entity, which is a utility company, in which the government indirectly owns 75% share, with a loan equivalent to 50% of its funding requirement. Government has provided that loan, and the loan is repayable in quarterly installments over 5 years. Interest is charged at 3%, which is comparable to interest charge on bank loans. So even if the interest charge is comparable, even if it's arm's length, but because it is in the transaction size is significant, the loan is equivalent to 50% of its funding requirement, the transaction is significant in size, and therefore such a disclosure will need to be made even in case of a government company. And similarly, if they are collectively, there are similar disclosures to be made. An example is on the screen. I won't go through the details of it. So again, coming back to the crux of the topic, why is this important? So before we have Ind AS 24, and for companies that are not listed and that are below the threshold, we have AS 18. There have been penalties under AS 18 as well. So let us not think if the company is a smaller company, it is, related party disclosures are not important. I found the example of a company called Century Global Logistics Private Limited, which was penalized. The amount is very small. It was penalized only for around 20,000 rupees by the MCA for failure to report related party transactions with a company which had substantial interest, right? So the penalties are equally applicable to companies that are smaller or companies that are private and unlisted. There are penalties that have happened because the company paid lease rent to its director and relatives. The amount was approved by the board, but there was no disclosure of it. So even though they had board approval, all the procedural requirements are there. Because of failure to disclose, the company was penalized. And globally, of course, we know Enron is the leader in bringing this culture of corporate governance and transparency. And the Enron case was typically this. There were special purpose entities that were created which were controlled by the executives of Enron, and it hid lot of debt within these entities, inflated earnings, and did all of that, because of which whatever happened with Lehman Brothers, with Enron happened, and after that we have Sarbanes-Oxley. So, in India also we have Satyam. Satyam was similar, where there was inflated income, and there were a lot of in the background related party transactions, because of which there was inflation of income, overstatement of cash, profits, etc. So we have a number of such examples globally, which underline and underscore the importance of disclosing related party transactions openly and transparently. So that brings me to the end of my presentation. And I'm going to stop sharing my screen, and we can bring up a few more questions, which we can pull the audience. And Nitish, any questions you have on the topic, we can take them up.
So, Maitriji, let us complete the poll questions first.
Yes.
Sure. So, do you want to take up the poll question?
Yes, we can take up the next poll question, which is, there is an individual who is a non-executive director in a company. So does that individual who is a non-executive director, become a related party of that organization?
The next one now.
Do we have responses for the first one before we move on to the next one?
The responses will be fetched from the backend.
Okay. So I'll give the answer to the first one. So we discussed that in the definition of a related party, and a non-executive director is also included. So whether a director is executive or non-executive, it becomes a related party to the organization. Okay.
So
the next.
Maitriji, I have a question which is, again related to directorship itself. So I thought I'll just bring it up. It seems more pertinent now. So the question is, if the director of a company A, is also a director in a company B, the company B is a subsidiary of company C. So then will company A and company B be related? Company A and company C be related? So there's a common director between company A and company B. Company B is a subsidiary of company C, and whether A and C are related.
So let's first talk about whether A and B are related. Right. So company A, company B, both of them have a common director, but they don't have a common parentage. I'm assuming that there is no common parentage. So two unrelated companies have a common director. Those two unrelated companies are not related to each other. Okay. Right. So just because there's a common director between the two, as per Ind AS 24, they are not related to each other. So company A and B are not related. So obviously company A and C are not related either.
And so just extending the question at my end, what if the relationship was to be such? So the directorship was rather they were KMPs, or the KMP was a common KMP, or say any other reason by virtue of which A and B would have been related. Then in that case, would the holdco of B be related to an independent company A?
So if the two companies are related on account of somebody who's exercising common control,
right,
or they're part of a common group, which means that group is exercising either significant influence or control over them. And therefore, these two companies are related to each other. If these two companies are related to each other, then the parent company of any one of them is also related to the other.
Right. Another question, which is again a little similar. So a person is an independent director in a bank, and that same person is also a director in a company. Now that company wants to borrow from the bank. Will this come under RPT, even though the person is an independent director? and does not hold any shares in shares or any does not have any say in terms of approving the transaction of the loan by the bank.
Right. Just because two companies have a common director, they are not related to each other. First thing.
Right.
Second, the transactions that are not covered by related party is transactions such as banks. So if you're borrowing money in the ordinary course of business, that is not covered. It is not a related party transaction, right? So going by both lenses, this is not a related party transaction requiring disclosure under APS 24.
So I think we can circle back to the poll questions before we move on to the next set of
Yes,
questions from audience.
the next poll question that we had is A Limited is an associate of B Limited, but there is no transaction with B Limited during the year. Does A Limited need to make detailed disclosures as per Ind AS 24? So where there are associates, it's a case of significant influence. And it falls within category 2 of disclosures, which means we make the disclosures only if there's a transaction. So since there is no transaction, no disclosure is required because it's a case of significant influence, not a case of control. In case of control, in case of subsidiaries, the mere existence of that relationship needs to be disclosed. But in case of associates, you only need to disclose if there is a transaction. The next question is, a company is an R&D company producing defense goods for the government. So does it need to make detailed disclosures for transactions with the government? So transactions with the government do not need to be disclosed unless the transactions are significant, individually or in aggregate. So assuming the transactions are not significant, there is no disclosure to make. In case there are significant transactions, then just a note clarifying what are the transactions that would need to be given along with the financial statements. I had asked a question, Nitish, during the session on if father-in-law is a related person. And
in terms of Ind AS 24.
Yes.
So do we want to leave that as a poll for the audience, or is that a question to me?
It's a question to the audience.
Sure.
I will not put you on the spot. It's a question for our audience. Is do in-laws qualify as related parties as per Ind AS?
Also, Mitriji, would you like to cover the question answers to the polls that the questions that we covered earlier? So the first one being A Limited is purchasing 70% of its total sales of B Limited. Is there a related party transactions?
So yeah, I'll come to this. Let's cover the in-laws question first. So if you got any responses for that?
Not exactly sure if I'm supposed to be able to see the responses from the audience.
Okay. So both Companies Act and Ind AS do not cover in-laws under the definition of related party. So they will not be considered related party unless under some circumstance they fall as a dependent. So if it comes under the category of dependent, then they are related party. But other than that, they are not related party, neither as per Companies Act nor as per Ind AS 24. Okay, we'll come back to the two poll questions we've left. One is A Limited is purchasing 70% of the total sales of B Limited. Is there a related party transaction? So just because one organization sells a majority of its produce to another organization doesn't make them related party, as far as the selling organization is able to independently take its commercial decisions on how to run its organization. The next poll question was, a company is a sole selling agent of another company. So is it a related party transaction? So just because it's a sole selling agent doesn't make it a related party unless the other company exercises control or significant influence. If there is no control or significant influence over the decisions of the organization, and the organization is able to independently take its decisions on where to deploy its capital, what to do with its money, how etc., etc., then there is no case of control or significant influence, and therefore there is no related party transaction.
So we've got one more poll question that has not flashed up on the screen, but we've got one more. So A Limited is taking the KMP services from C Limited. The accountant of A Limited wants to show remuneration details of the directors of C Limited. Is he correct?
Let's wait for the responses.
So since it's not flashing on the screen, I'll just repeat the question for the benefit of the audience. A Limited is taking KMP services from C Limited. So that means C Limited is providing the services of KMPs to a company A Limited. A Limited, who is the recipient of these services, wants to show the remuneration details of the directors of C Limited, whether they should or not.
So KMP services have become very, very important. We have companies that are providing CEO services, CFO services, chief risk officer, and so on. So KMP services are becoming very popular in the market, and with that, India's 24 gives under persons, individuals, the relation is only if the person has control or if the person is himself a KMP. Organizations that provide KMP services fall under entities. Now, in the definition of entities, one of them is if a company is providing KMP services, then it becomes a related party. So the company that's providing KMP services is the related party, not the individual. Since the individual is not the related party, the remuneration of the individual does not have to be disclosed. Rather, transactions with the company have to be disclosed. So if we remember that table, the middle column of it, which is category 2, where you have a transaction with a company and there is significant influence, then you have to disclose the transactions. That's what will apply. It's a related party. If we consider it as being control, then control, the relationship has to be disclosed as well as the transaction. If we consider it as significant influence, then only transactions. But it is not an individual, and therefore the remuneration details of the directors of that organization don't need to be disclosed.
Mitriji, if I may interject on this one a bit more. So these services, I understand a lot of these firms today provide a lot of these services under the banner of, say, virtual CISO, virtual CRO, virtual CFOs. You and I may be providing these services in the name of virtual CFO to a lot of our clients as well. But typically, they would be the name of our services, but we would actually not be acting as the CFO, or neither would our firm be acting in that capacity. We would, at the end of the day, just be their consultant. So they may be acting on our advice, but they would not be, be taking our, we would not have that authority. So question number one, whether there are scenarios where an entity who supplies an individual the services of an individual also asserts the assumes the role of a KMP themselves, question number one. Question number two, whether, this kind of, so I am aware that this kind of thing does happen outside India. So you do have companies and say a lot of these fund structures, etc., have various of their directors and authorized signatories, etc., being taken on a loan staff basis or on a representation services basis from various independent firms. So over there, I've seen. But how does it work in the Indian context, and what sort of disclosures would apply?
This is an evolving market, Nitish, as you're aware, and a lot of firms are cropping up providing fractional CFO, remote CFO, virtual CFO, for the finance fraternity that's listening to this call, that would be very relevant. And CFO obviously is a KMP for an organization. So these are KMP services, right? The contract that is being entered into is for KMP services. And therefore, KMP services, any organization that's providing KMP services becomes a related party. So ideally, the relationship and if there is control. So the key point here is their control. And what you said is very right. A lot of times, what can be given as an opinion and advice, an option for them to follow among several series of options is what, as CFOs, we provide to organizations. But the actual decision is made within their boards or within their, whatever level is there, which is the decision-making authority, the chief decision-making authority over there. But that doesn't take away from the fact that these KMP services are there, and it is usually on the advice of a KMP that a decision is taken. It is very rare that the organization says my KMP service provider is advising me X and I decide to do Y. It's very rare that happens. The reason that they are taking on KMP services is they don't have the expertise and they want expertise to lean into. So and the circumstances where they may take a slightly nuanced view in organizations is where we give options, and they may choose a higher risk option or a lower return option or a slower return option or things like that, which will be among the basket of options that are provided by the KMP service provider. So the KMP service in some ways definitely exercises significant influence, if not control. So the transaction value certainly needs to be disclosed, if not just the relationship. And wherever there is a relationship of KMP services, there definitely would be a transaction too, because it's a commercial relationship by very definition.
Right.
To come back to the question you had raised, Nitish, I'm no expert on SEBI listing, but because to my knowledge, the SEBI listing disclosures have also encompassed the debt securities. So there's some three-tiered approach or something like that. I'm not very familiar with it. But there is a certain threshold below which the disclosures are fully exempt. And then there are basic disclosures for a certain threshold, and then there are the full disclosures for a certain threshold of debt. But the disclosures remain even in the debt listing, as far as I know. But I'm no expert on it, like I said.
So I've seen a couple of debt listed companies myself, and we've seen their Ind AS disclosures being prominent. So they've not yet disclosed. Maybe they may be falling in the lowest threshold bracket. That may have been one of the reasons. But I've seen a lot of these companies that do not report relationships which are as per the SEBI requirements, but only relationships which are as per AS 18 or Ind AS 24. So that's my 2 cents on it, or rather my awareness on the subject. But I'm sure the tiered approach may have something more to it. Right. Then another question we have, whether related party disclosure requirements prescribed in Ind AS 24 apply in circumstances where providing such disclosures is in contravention to or prohibited by a statute or by any regulator.
Superb question. So this is a specific safety net provided within the Ind AS. So the International Accounting Standard IAS 24 does not have this. Ind AS says that where there is a statutory requirement not to disclose, then you don't need to make the disclosure. And some examples that come to mind is if it's a banking relationship or something like that, which should not be disclosed, or if there's privacy concerns because of hospitalization data with a related party not needing to be disclosed, then it does not need to be disclosed as per Ind AS. As per IFRS, IAS 24 does not have this exemption. And so if we were following within the IFRS, then it would need to be disclosed, but Ind AS has an exception because of which any rules, regulations, laws, statutes, statutory authorities that prevent disclosure of information, then such information need not be disclosed as part of India's 24 disclosures.
But does such fact need to be disclosed that there is certain information that we are not being able to disclose? No.
No. So if there's let's take the example of one of the large hospital chains, and if their promoters get hospitalized over there, then it's obviously a related party transaction.
Right.
But that does not need to either be mentioned or be disclosed. It's privacy protected, personal health information.
Got it. Got it. Is an entity required to disclose the compensation paid to KMPs? If yes, what are the components to be included in the disclosure?
So as far as KMPs are concerned, and their close relatives. So any payment made to the close relative would also need to be disclosed, because a close relative is also a related party. But let's stay with the KMP. So the disclosures required for KMP are on the table. If you recall the last column, it's a category 2 disclosure, which means the transaction value needs to be disclosed. KMP's disclosure will need to be in 5 categories: short-term employee benefit, other long-term benefits, retirement benefit, termination benefit, and the last one is share-based payments. So all these have to be disclosed separately as far as KMPs are concerned.
Mitraji, extending this question a little further at my end, we've seen in practice that a lot of these companies do not want to disclose the bifurcation or an individual salary. Then in that case, they take a combined approach and they disclose the gross remuneration being paid, broken down into parts, which you just mentioned. But they disclose just the remuneration that's been paid to KMPs in total instead of naming them one by one. So what is your take on those kind of disclosures?
The disclosure requirement of Ind AS 24 is very clear. With each related party, the transaction value needs to be disclosed.
Okay.
So, just extending your question, I could say transactions with all my joint ventures is one, consolidated number. That's not permitted. So with each KMP, this needs to be disclosed. That is the requirement of the standard. However, if companies are not disclosing it to that level of detail, then it's their choice to face the consequences. I have actually seen a lot of companies making this disclosure, though, Nitish.
Right.
Like you go into the annual report, and there are organizations that are doing benchmarking. At the basis of their benchmarking is just the annual report. They're doing benchmarking by industry for independent director salaries and sitting fees and things like that. And this is happening because individual disclosure is available on financial statements. So there are a lot. I think we should look at the bright side also. Corporate India is quite compliant, and in fact, very, very compliant. If you look at financial statements from around the world, I'm sure you have in your experience done that. I feel the disclosures we see in Indian financial statements are very, very impressive.
Right. And I think the overall Schedule 3 framework is something that's really supplementary, because the way that we've seen outside, the primary thing that I feel is that there's a large level of inconsistency between how different entities report differently. So, a company working in the same segment, maybe of the same size, maybe disclosing or presenting their financial statements in a completely different format than, say, another one doing a similar line of business with a similar size. So I think the overall
Absolutely.
Schedule 3 requirements and the lot of guidance notes that are there, where, under the aegis of ICAI, is something that are very instrumental to ensuring transparent disclosure within the country. Okay, so another question we have: how much detail is enough in RPT disclosures to satisfy transparency expectations without overwhelming readers?
The amount of detail that is required to be disclosed is given as part of the standard. Okay.
Right.
And it's fairly detailed. What is the amount of the transactions? What's the closing balance? What's the outstanding balance at the end of the year? How much commitment is there? Is there any guarantee given? Is there any provision for doubtful debt on the outstanding balance with a related party? Anything that's been written off as a bad debt with the related party? Then you have to say how many transactions with parent, how many transactions with, like, what are the details of transactions with parent, each entity with joint control, subsidiary, associates. The whole list of what are the disclosures are very clearly spelled out in the standard.
Right.
So optionality is not an option. The standard is very, very clear, and we need to follow what is given in it.
Another question from the audience is: if a company believes a transaction is at arm's length, does it still need to be disclosed under Ind AS 24?
Arm's length is not a criteria for Ind AS 24. So
Sure.
Ind AS 24 only needs the existence of a transaction, and in certain categories, just the existence of a relationship. That's the category 1, where there is a relationship. I have a subsidiary, I have a parent. Just the fact that I have that relationship needs to be disclosed, whether or not there are any transactions. Secondly, if it's not in category 1, if it's in category 2, then it doesn't need to be arm's length, or it can be arm's length, but the transaction value will need to be disclosed. Closing balances will need to be disclosed. So arm's length is not a criteria in DS. I'll go back to the previous question, Nitish. The question primarily was, what is the minimum disclosure needed to satisfy Ind AS?
Right.
I will say we don't make disclosures to satisfy Ind AS. We make disclosures for the purpose of transparency for the readers and the stakeholders. To whatever is material to a stakeholder should be disclosed. Whatever is not material should not be disclosed, right?
Right.
So we are not making disclosures to satisfy Ind AS. Ind AS is made with the intent to provide guidance on how you can satisfy these stakeholder requirements. So Ind AS is a tool in our hands. Ind AS is meant to facilitate us to provide disclosures that satisfy stakeholders. But the ultimate objective is to satisfy a stakeholder. Somebody who's a decision maker should have enough information on their hands, which will help them make a reasonable decision with the parameters that will influence their decision. So I would say that we're not doing anything to satisfy Ind AS, we're doing it to satisfy end stakeholders.
Sure. We've got a couple of more questions. So one of them is: how should interest income and loan transactions with related parties be disclosed, on a gross basis or on a net basis? I think this is a very valid and interesting question. Sorry, your mic's on mute.
Sorry, once again, if you could repeat, how should interest
income, or rather, I think the question of the audience is interest income / interest expense, and loan transactions, that is loan taken, or say loan repaid, or
given?
loan
Okay.
given.
So there is a
Gross or
component
net?
of loans. Gross.
Correct.
Long answer short, gross. So each is an individual transaction.
Right.
There are two transactions. If there's interest received and there's interest paid, it's because there are two different agreements, one for a loan taken, one for a loan given.
Right.
If there are two different transactions, each of these transactions needs to be separately disclosed, which is why I said gross. As far as related party transaction is concerned, it needs to be gross. Within your financial statements, in your interest schedule, perhaps you could do it net, but within the RPT note, it has to be gross.
And extending this question a bit, with respect to, say, a loan transaction, which is in the form of a credit line with one of my related party. If I keep on drawing the line, and if I keep on repaying it, So what number do I disclose? The net repayment or the net loan taken, or the gross repayment and the gross loan taken?
So one is the closing balance. What's the
Right.
closing balance at the end of the year that needs to be disclosed? And you could disclose the gross total maximum amount, during the year. So and the fact that there is a credit line which is being drawn upon, and at during the course of the year, the maximum drawdown amount against the loan was so much.
Okay. So if I've say borrowed 100, and if I drawn 100 and I repaid 80, so the net transaction was in essence 20. Will
It's
I be
20.
disclosing 20, 100, or 80?
I'll disclose 20 as the closing balance, which is a mandatory disclosure under Ind AS.
Right.
And as a note, I could always say that this represents a credit line of credit taken from my parent company,
Sure.
which was sanctioned for an amount of 150 crores, and maximum amount drawn down during the year was 100, and closing balance has been disclosed.
Sure. There's another question, which although at the outset seems to be around the valuation of your related party transaction, but I'll throw it out to you. How do shared services between group companies, say HR, IT, procurement, or any other supply of staff, need to be evaluated for related party treatment?
So shared services between group companies would mean like corporate services.
Right. So, for example, I've got a common HR for two of my companies. One has the HR staff on its payroll. The same staff does these, manages the payroll or all other HR functions of the other related entity as well. So then, in that case, how do we? What are the related party considerations? So of course, this relates to valuation of these. To my sense, the question has been framed in a way where they're likely asking about the valuation of these services, which, to my understanding, based on whatever you've taught so far, is out of the purview of the Indians. But if in case you've got anything to add.
So it's nice to have an attentive audience. Thanks, Nitish. So in DS, whenever there is shared services, we're talking about group entities. So there is a holding structure and group entities. And within a holding structure with group entities, what we understood was the very existence of that relationship needs to be disclosed if it's parent subsidiary. So the existence of this parent subsidiary relationship and what are the transactions. So a disclosure that HR, finance, etc., common services which sit within the parent organization and subsidiaries draw down on those services, something to that extent needs to be part of the disclosure. Now, whether or not a price is paid is the second part. Indian transfer pricing regulations are different, of course, and they may or may not kick in. So if they don't kick in, there is no necessity to exchange a price. And therefore, even if there is no price, such a disclosure which says these are common services which sit under a parent entity will need to be made. If there's actually a price being exchanged, which is a transaction price, then such price will form part of the disclosure, and the closing balance of whatever is outstanding will need to be mentioned. If there is any bad debt written off, things like that, that will need to be disclosed. Like you said rightly, Nitish, how much should these services be valued at is not a subject that Ind AS deals with. It's a subject that transfer pricing laws will deal with, valuers will deal with, and so on, but it's not a subject of Ind AS.
So, Maitriji, what happens in case my TP officer, in case of an international transaction with a related international related party, if my transfer pricing officer TPO makes an adjustment and say increases the amount or reduces the amount by certain proportion, then in that case, does that affect my financial statement or my disclosures to the financial statements? I mean, apart from a tax disclosure or say a liability disclosure kind of thing, does it affect my related party disclosures?
So it does not impact your related party disclosure because you're making the disclosure at a point in time.
Right.
The TPO will come in, 18 months later and make the adjustments, and you'll probably contest it even further, right? So by the time you actually pay something, it's going to be several years, and your financial statements, we don't have the We don't have the concept of prior period adjustments any longer.
Right.
So at that point in time, when you make the disclosure, you make a disclosure of the relationship and of the transaction as you see fit at that point.
Sure.
Now, coming to that TPO adjustment at the point that it is levied, if you believe it's a contingent liability, then it needs to be accordingly disclosed in the notes as a contingent liability. At the point the adjustment is actually made, it will need to be accounted for as an expenditure, along with penalties, interest, and so on and so forth.
So I think with this, Mitriji, we've got all our questions cleared, and we've responded to all our audience's questions. And certainly feels like your content coverage is also complete. So I'd sincerely like to thank you for sharing your valuable insights and explaining the topic very crystal clearly. Your expertise greatly benefited our audience. We also would like to extend our gratitude to the ASB's leadership team and the Accounting Standard Board's leadership team, Chairman C.A. Sanjeev Singhal sir and Vice Chairman C.A. Vijay Doshi ji for successfully organizing the Brain Gain Expertise Series. This initiative has helped our members and continues to help our members and stakeholders gain useful knowledge. A big thank you to all the participants as well for joining and engaging in this webinar. Your involvement does make these events worthwhile. Thanks again for your support, and the ASB team as well, who's facilitated, Rahul, who's been very helpful, and the tech team who's been very helpful in helping this session become a success.
Thank you, Nitish.
Thank you.
Thank you.
Thank you.